Welcome to the deep dive. We dive into sources to pull out the key insights for you.
And today we're looking at, well, a giant in the investing world through Warren Buffett, The Ultimate Guide to Investing.
Right. This guide isn't just about, stock tips. It digs into his life, his core ideas.
Exactly. It's the philosophy behind the success story.
So maybe you're listening and thinking, investing Buffett, it all sounds a bit much, maybe intimidating.
Yeah, the numbers can seem huge, the stock market confusing.
But our goal here isn't really to make you the next Buffett. It's more about understanding the fundamental ideas, smart investing principles.
And maybe getting a better handle on the economy itself, without all the jargon.
We want to make it feel more accessible. Focus on those lasting ideas.
So what's the plan? Where are we going today?
Okay, so first we'll trace Buffett's journey, how he got started. Then we'll really break down his core investing approach, the Warren Buffett way.
And his portfolio strategy.
Yeah, we'll look at that and also some of those famous motivational quotes he has.
Sounds good. People often wonder what makes his method so, well, durable.
Let's dive in and unpack that. So starting with his road to success. Born in Omaha in 1930.
And it seems he had this knack for investing, for numbers, really early on. Like, apparently his high school yearbook even called him a future stockbroker.
Huh, yeah. And that entrepreneurial drive. Selling gum, magazines.
And buying stock at 11 for himself and his sister.
That story about selling too early, watching the stock soar after he sold.
Ouch.
Yeah.
A tough lesson, but valuable, right? Patience.
Absolutely. And the numbers from his youth are, well, pretty amazing. Filing taxes at 13, climbing his bike.
Yeah, and the pinball machine business.
Yeah.
Turning that into real money. Saved $90,000 by the time he finished college.
That's just incredible focus for someone so young.
Really shows that early financial mindset.
His education path is interesting too. Wharton for a bit, then Nebraska, got rejected by Harvard.
Which led him to Columbia, specifically to study under Benjamin Graham. Huge influence, right?
Absolutely pivotal. And then after school, his determination. Wanting to work at Dyco, pursuing Graham.
Even offering to work for free.
Yeah.
That says a lot about his drive.
Definitely. And then finally working for Graham, starting his own partnership back home.
Buffett partnership, yeah.
Yeah.
Investing in those undervalued companies.
Yeah.
That's where the Oracle of Omaha nickname really started taking shape.
And growing those partnerships, meeting Charlie Munger, that was critical too.
Right. Pooling capital. He didn't put in much of his own money initially, did he? Used leverage smartly.
A very sharp move. And then the Berkshire Hathaway acquisition.
Which, funny enough, the book says he initially thought was a mistake.
Really? Why?
Opportunity cost, apparently.
Hmm.
He felt the money could have done better elsewhere at that exact moment. Started as textiles, then he transformed it.
Into the huge investment vehicle it is today.
It's that long game, isn't it? From kid entrepreneur to billionaire in 1990, riding out storms like the Great Recession.
Even named wealthiest person in 2008 for a bit. It shows the power of sticking to your principles over decades.
And the philanthropy commitment to pledging almost all of it.
Yeah, that's remarkable. So, key things from his journey. Start early, persist, smart investing, definitely that long-term view.
Couldn't agree more.
Yeah.
Okay, so let's get into the core philosophy, the Warren Buffett way. Hagstrom's book really lays it out.
It does. It gives us those practical principles. Hagstrom boils it down to four main things.
Okay, what are they?
First, buy businesses with good long-term prospects. Companies that will last, not just fads.
Makes sense? Durable competitive advantage, that kind of thing.
Second, buy them for way less than they're actually worth. Undervalued.
The value investing core.
Third, look for businesses with a high return on the capital they invest. Efficient companies.
Got it. And the last one.
Super important. Honesty and integrity in the management. He really emphasizes that.
So he sees himself as an owner, not just a stock picker. He wants to understand the business inside out, work with management.
Exactly. It's not about timing the market day to day. The stock market's just a mechanism, he thinks. The real value comes from the company's performance over time.
Right. Forget the wider economy. Focus on the specific business. Understand it.
And he looks at return on equity, not just earnings per share. Thinks about his collection of businesses.
You can really see the influence of his mentors there.
Oh, absolutely. Benjamin Graham gave him that margin of safety idea.
Can you unpack that a bit? Margin of safety.
Sure. It's like, imagine buying a car. The seller wants $10 K, but your mechanic says it's really only worth $7 based on its condition.
Okay.
That $3,000 difference, that's your margin of safety. It protects you if maybe your assessment is a bit off or if something unexpected goes wrong.
So in stocks, it's buying way below what you think the company's true long-run value is.
Exactly. It's a buffer against error and bad luck. Graham also reinforced that long-term focus.
And the other mentor, Philip Fisher.
Fisher emphasized checking out the management's quality, their integrity. And interestingly, Fisher believed in concentrating investments, not just diversifying everywhere.
Right. Focus on what you know really well. Consistent businesses.
And Buffett wasn't put off by not having huge personal capital early on. He used partnerships effectively.
He also talks about calculating owner earnings, right? What's that about?
Yeah, it's trying to figure out the real cash flow a business generates. You start with net income, add back things like depreciation.
Because that's not actual cash going out.
Right, but then you subtract the capital expenditures needed just to keep the business running as is, maintain its position.
So it gives you a more realistic picture of the cash you could, theoretically, take out without hurting the business long term.
Precisely, a truer measure of profitability for an owner, and it all comes back to his famous quote.
Risk comes from not knowing what you're doing.
Exactly. Knowledge is the antidote to risk, in his view. So for beginners, maybe focus on really understanding a few things well.
It seems like sound advice based on his approach. Okay, let's shift to the Warren Buffett portfolio. What does that actually mean?
Well, a portfolio is just your collection of investments, right? The guide makes a useful distinction.
Between mutual funds and hedge funds.
Yeah, mutual funds are generally safer for newcomers. You get instant diversification across many stocks. Hedge funds, well, they're usually smaller groups, higher potential returns, but definitely higher risks too.
And Buffett's main vehicle is Berkshire Hathaway, his holding company.
Right, he's CEO, largest shareholder, controls subsidiaries like Geico and many others. It's huge, the book mentioned, around $200 billion market value then.
And a lot of the big holdings are those established, maybe even slightly boring companies, right? Coca-Cola, See's Candies.
Exactly, businesses with strong brands, predictable cash flow. He's not chasing hype. He wants companies he understands. That'll likely be around for ages. Predictability is key for him.
That story about how he bought Berkshire is wild, though.
I know, not some grand strategy, but because he felt personally slighted by the previous owner over a few cents per share when he planned to sell.
So instead of selling, he just bought the whole company out of spite, almost.
Pretty much, and then called it his biggest investment mistake because of the opportunity cost. What he could have done with that money elsewhere.
Wow. Even the Oracle admits to big errors. It's kind of reassuring, actually.
It is. Nobody's perfect. But overall, that portfolio reflects his core ideas. Large, solid companies bought using value investing.
Can we just quickly define value investing again?
Sure. It's buying stocks or securities for less than their intrinsic value, their real underlying worth. The gap is your margin of safety. It works well with companies having tangible assets you can value.
But the book mentions a potential downside.
Yeah, that relying purely on it sometimes requires, well, maybe inside knowledge or connections to get the edge, which not everyone has.
Right. Which leads to the recommendation for many people. Index funds.
Exactly. Index funds just track a market index, like the S&P 500. People like John Bogle champion them, and Buffett and Munger agree they're great for most investors.
Why? What are the benefits?
Low risk because they're super diversified, low fees, and they tend to be tax efficient. Simple and effective.
Good point. Building a portfolio takes time, research. It's not instant. The guide says outsiders are at a bit of a disadvantage.
True. You need confidence, but not overconfidence. And remember, no guarantees. Don't put all your eggs in one basket, especially thinking back to things like the 07-08 crisis.
Definitely.
Yeah.
Okay, let's talk about the Warren Buffett stocks, specifically Berkshire Hathaway shares, and maybe link that to the crisis.
Right, so Berkshire has two types of stock. Class A.
The original ones,
Hmm.
famously expensive because they've never been split, right?
Exactly. Buffett did that deliberately to attract long-term investors, people who wouldn't just trade them quickly. Limits volatility.
And then there are the Class B shares.
Yeah, created later, much cheaper, split multiple times, makes them accessible to, regular investors.
And the book draws a line from this to the subprime crisis. How?
It's more of an analogy, I think. The contrast between the super stable, high-priced Class A and the more accessible, potentially more traded Class B, it mirrors how different levels of risk and accessibility existed in the mortgage market.
Ah, okay. Not a direct cause, but a similar concept of tiered risk.
Sort of. Think about the crisis. Banks bundled mortgages, including risky subprime ones given to borrowers less likely to repay.
Those became CDOs, collateralized debt obligations.
Right, sold as investments.
Yeah.
The idea was diversification, but when too many risky loans got packed in, the whole thing became fragile, especially the lower rated parts.
And many didn't understand the real risk they were buying.
Plus, leverage borrowing heavily to invest magnified everything. Small losses became huge ones when the housing market turned.
Creating the bubble and then the crash. A
Yeah.
global mess.
The key takeaway, though, is the market isn't just luck. You need common sense, informed choices.
And maybe avoid those get-rich-quick schemes with crazy high risk. Even the pros lose money sometimes.
No magic formula. It's educated guesses, watching trends. Sometimes, yeah, maybe knowing the right people helps too.
Okay, let's move to something maybe a bit more uplifting. The motivational Warren Buffett sayings. I always find these insightful.
Me too. They really capture his personality and business sense. The book highlights quite a few.
Let's pick out some key ones. How about someone is sitting in the shade today because someone planted a tree a long time ago?
Oh, I like that one. It's all about that long-term view, right? Appreciating what came before and building for the future.
Definitely. What about it takes 20 years to build a reputation and 5 minutes to ruin it?
Powerful. Really hammers home the importance of integrity, reputation, think before you act.
So true. Then there's the most important thing to do if you find yourself in a hole is to stop digging.
Huh. Simple, but brilliant. Recognize when you're making things worse and just stop. Cut your losses, reassess.
Good advice for life, not just investing. Okay, next. Price is what you pay. Value is what you get.
Classic Buffett. Focus on the quality, the intrinsic worth, not just the sticker price.
Makes sense. How about honesty is a very expensive gift. Don't expect it from cheap people.
A bit cynical maybe, but highlights that integrity is valuable and maybe not universal. Choose your partners wisely.
Wise words. And there comes a time when you ought to start doing what you want. Take a job that you love.
Yeah, pursue passion, not just credentials. Important for a long-term happiness.
And this one resonates. No matter how great the talent or efforts, some things just take time.
Patience again. Can't rush everything. Some things need to mature.
Crucial in investing. Okay, the famous rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1.
Obviously, you will lose money sometimes, but it's about the mindset, isn't it? Prioritizing capital preservation. Don't take foolish risks.
Exactly. The goal is loss avoidance. Then it's better to hang out with people better than you.
Choose your influences. Surround yourself with people you admire and can learn from. They lift you up.
Good point. And back to a core theme. Risk comes from not knowing what you're doing.
Knowledge, understanding. That's your best defense against real risk.
How about this one? Should you find yourself in a chronically leaking boat, energy devoted to changing vessels is likely to be more productive than energy devoted to patching leaks.
Knowing when to cut bait. Don't throw good money or energy after bad if the fundamental situation is flawed. Move on.
Very practical. Then, there seems to be some perverse human characteristic that likes to make easy things difficult.
Keep it simple. Overcomplicating things often doesn't help. Seek clarity.
Love it. And in the business world, the rearview mirror is always clearer than the windshield.
Learn from the past. Hindsight is 20/20. Use it to inform future decisions, but know the future is uncertain.
Okay, nearly there. The difference between successful people and really successful people is that really successful people say no to almost everything.
Focus. Saying no to distractions allows you to say yes to the really important opportunities. Selectivity.
Great point. And finally, that Dexter shoe anecdote. The $400 million mistake.
Yeah, went to zero. It's just a reminder that everyone makes mistakes. Even Buffett learned from it, move on, don't let it paralyze you.
Humbling, isn't it? Okay, so the book wraps up with some final Warren Buffett investing tips.
Right, let's quickly cover those. Tip 1, the time is now.
Meaning, even after crashes or recessions, there are always opportunities for the long term, like how he invested in 2008.
Exactly. Don't be paralyzed by fear. Look for value when others are panicking.
Okay, tip 2, think of the long term.
We've hit this a lot. Stocks are inherently risky if you have a long horizon and you're diversified. Avoid putting all eggs in one basket, avoid high fees, avoid too much leverage.
Makes sense. Tip 3, do not place your trust in claimed stock market experts.
Even Buffett says he can't predict short-term market moves. So be skeptical of people who claim they can, especially if they charge a lot. Remember Alan Greenspan before the housing crash?
Right. Nobody really knows. Anything can happen. Be prepared for unpredictability.
And the last one, tip 4. Be decisive and confident.
So do your homework and then act. Don't dither.
Yeah. Logic should rule, not emotion or procrastination. He apparently lost money on Tesco stock because he was too slow selling it. Once you've decided logically, act. But always be prepared for the worst case, too.
Good summary. So wrapping this all up, our deep dive shows these recurring themes, doesn't it? Long-term thinking, value investing,
Understanding the business, integrity, learning from mistakes.
and accepting that the market is, well, unpredictable.
And like we said at the start, this wasn't about a get-rich-quick formula.
No, it's about understanding a sound, time-tested philosophy for investing and maybe finance in general.
Hopefully for you listening, this gives you a framework, makes finance feel a bit less daunting.
Yeah, maybe it empowers you to make more informed choices, understand the economy a little better through his lens.
So let's leave you with a final thought to chew on. Given Buffett's focus on long-term value and everything we learned from past bubbles, what overlooked industries or companies today might actually hold significant potential if you look patiently, discerningly?
Something to think about beyond the daily noise.
Yeah.
Where might that hidden long-term value be lurking?
Exactly. Food for thought.
Well, thank you for joining us for this deep dive.